Nilesh Shah is our market master of the day. He's managing director at Kotak Mahindra Asset Management Company. Nilesh, great to have you with us here. Thank you very much. Prashant this side. So we've been so habituated to talking about interest rates in the West. Now we're talking about rates here in India with what we got yesterday in terms of consumer price inflation. Now, of course, I mean, the proportion of food in the CPI basket in India is actually much higher compared to many other countries. And that perhaps is one reason why, and of course, but having said that, this is the benchmark which the RBI uses. How do you look at it? And economists expect so instead of August now, the rate hikes, the 25 basis point first hike perhaps is brought forward. How is the market going to take it, according to Nilesh?
Thank you, Prashant, for having me over here. If we look at from a debt market point of view, our current 10-year yield is 7.11%. It's roughly about 311 basis point over overnight rate or repo rate. Now, normally this spread is roughly about 120 to 150 basis point. That means debt market has priced in repo rate hike of between 4 to 5 times. Now, whether that happens in next month or after 6 months, it's not going to make a material difference. What debt market will be looking forward to is the trajectory of inflation. Does it remain elevated above RBI's target level of 6%, or does it start coming down as expected by the RBI, which has guided towards 5.7% inflation for FY 2023? From an equity point of view, it is the credit flow along with cost of interest rate. We have seen compression in credit spreads where AAA rated and AA rated bonds are trading today at much lower spread than historical averages. In fact, there are certain PSU bonds, corporate bonds, which are trading below state development loan yields. So equity market will be looking again at the cost of borrowing of the corporates. This year has been fantastic from a deleveraging point of view. Even heavily leveraged companies in commodity space have used the benefits of cash flow towards repaying debt. So in all, it will be a fluid situation, but to a great extent, RBI's moves has been well discounted in both debt and equity market.
Okay, by the way, the metals are surging now. The commodity complex, JSW Steel is leading it now. Vedanta is another stock. Vedanta, of course, has benefit of crude also going up. Nilesh, good morning. First of all, thanks a lot for for joining us today and for obliging us. Nilesh, I was talking to a large fund manager 2 days back, and he was making a point that the B group is really on fire, and there are so many opportunities. But at some point, you feel a bit scared as well to invest fresh money at these levels. Your thoughts? We've had a really massive rally in the B group.
So Anuj bhai, I think this is the time where all options are open. Oil could go to $200 if Ukraine gets escalated, and a cornered Russia ends up doing something which is not priced by the market today. Oil can come down to $50 a barrel if Iran and Venezuelan oil starts coming into the market as America lifts the sanctions, and Russia continues to break the cartelization and pump the oil, and then Saudi follows it. On US interest rates today, 3.5% is also possible if the employment data is an indicator, and 1% is also possible if curve inversion is an indicator of the recession coming through. In India also, we are seeing inflation above RBI's target zone. It can remain elevated. In that scenario, markets will be adversely impacted, or it can come down. In that scenario, market will be supported. So in this kind of uncertain environment where US rates, Indian rates, oil prices could go in either direction, I think it is important for investors to be unleveraged. Please don't leverage in this market. Anything can happen. Second, please maintain your asset allocation. If market comes down and valuation becomes cheaper, keep on nibbling at the bottom, keep on accumulating when markets are correcting. And if markets are rising sharply, then there's no harm in taking some profit.
I guess it's also the only way to beat this inflation, right? I mean, with inflation soaring like this, the only way you can generate some returns for yourself over the longer term is by investing in equities. And I guess the market has realized that. I mean, look at the SIP flows that we got in the month of March. But having said that, Nilesh, do you think one can continue to generate alpha in this market? And if yes, how does one do it? Because it's become increasingly difficult with the way valuations are going.
So we have been generating alpha. If you see most of our equity funds, they have still delivered positive alpha. And this is despite some of the challenges on the index. For example, in Nifty, recently Indian Oil Corporation was removed and Apollo Hospital was entered. Now that was about 1% of the index which moved. It was done at the closing prices. Now anyone in the market recognizes that if you want to buy Apollo and sell Indian Oil, there will be impact cost. The second thing is related to 10% cap on a fund weightage vis-a-vis benchmark index. Now HDFC and HDFC Bank will come together in index at 14-15%. No fund will be in a position to replicate that in active fund. There is also asymmetry in fund managers' view. So suppose if there is a stock which is 8% weight in the index, I can only go 2% overweight because beyond 10% I'm not allowed. So I can generate alpha on the underperformance side up to the extent of 8%, but on the outperformance side to the extent of 2%. And most importantly, mutual funds provide day-to-day redemption facility. There is daily liquidity. We maintain up to 5% cash to pay daily liquidity. Obviously, equity market over longer period of time would have outperformed cash by a significant margin. Despite those limitations, we have been delivering alpha, and I think active fund managers will be in a position to generate alpha.
It's just that, I mean, it's become harder and harder over the years, right? You would agree. So the skill required is also that much over very long periods of time.
Prashant Bhai, in my mid-cap fund, I have generated alpha of 9%. Now, if 9% is not sufficient for someone, then that greedy person can go into the market, play on its own. Very recently, a very famous online broker mentioned that 90% of their clients between March 20 to December 21 have generated losses. 90% when index moved from 7,500 Nifty to 18,000. In that scenario, where even if you had done nothing, you would have made money, people have incurred losses.
That was Nitin Kamath, right, Nilesh? Nitin Kamath, of course, admitting it.
Yes.
But you know, even then, 90%, 95% volumes come via trading in the market. That is
Anuj,
a fact.
If people want to lose money, what can one do? Market is not kind. It's a place where smart people will take money from dumb people. And we have seen that happening again and again. And if 9% alpha is not sufficient, then please be my guest, go into the market, burn your money, and then come back to mutual funds.
Nilesh, that's fantastic. Just curious, over what period is this 9% alpha and which fund?
This is Kotak Emerging Equity. I'll send across the data. And limited point here is that, Prashant Bhai, there are many index stocks which we are not in a position to replicate. I'll talk about 2017. There was one particular IT stock which had come into the mid-cap index, and it came at about 1%, went up to 4%, and most fund managers avoided that. Now, whole of 2017, we were underperforming benchmark index because we didn't participate in that particular stock. Today, that stock is down 90% and our funds are generating alpha. So whole of 2017, you could have told me that I'm useless, I have not delivered alpha. But I have to stick to my discipline. Eventually, that will pay off. And that's why we are generating this kind of alpha. In large cap indices, alpha is 0.5%, 1%. It is not 9%. But you know, if you can't replicate index, how will you outperform it?
No, so just a clarification. I mean, of course, this is is it a myth that index funds outperform actively managed funds? Because that's what we have been believing for years, right? That actively managed funds always underperform index funds, and that's why index funds are so popular.
Ma'am, please look at the data. In India, index fund itself underperform benchmark indices by 0.5% to 1.5%. We compare our fund's performance with total return index, not principal return index.
Okay.
Globally, when total return index is used, they are compared with gross of expenses return. In our case, we compare net of expenses return. Despite that, I'm delivering alpha, and despite that, I'm being told that you are not delivering alpha. Please look at the numbers. Please look at the data. Don't come without data.
Exactly, Nilesh, and of course, I give it to you, your team. I think Pankaj runs this successful fund. There's Harish, of course, Harsha. All of you have done well. But just like there are successful traders as well. So let's, there are a lot of traders who make a lot of money. So you can be successful in both, and of course you can be unsuccessful in both as well, right? There have been long-term investors who lost a lot of money in index stocks as well. That has also happened. Yes. Nilesh, go ahead.
You can play T20, you can play one day, you can play test match.
Yes.
But please don't try to play T20 in test match and test match in T20. Then it will be disaster.
Absolutely.
There are successful traders, there are successful investors. Yeah. There are failed traders, there are failed investors.
Unless you are a Virender Sehwag who can play all formats, stick to one format. That point is well taken. Nilesh, one last question then. What is the biggest risk factor for this market according to you?
I think, Anuj, the biggest risk factor will be complacency. I think this is the market where fundamentals can move in either direction. Oil can go up, it can come down. US interest rates can go up more than priced by the market. It can correct also. Indian inflation can remain elevated. It can correct also. In this kind of scenario where fundamentals can move in either direction, one cannot be complacent. And on a day like this, when you see every stock going up 3, 4, 5%, the breadth is very, very strong. It's bound to create some complacency. So we need to be grounded. We need to respect market and don't become complacent.
Okay, don't become complacent. Let's get back to the here and the now, Nilesh. Where do you see potential now for investors? Because there's so many new themes that are coming up, right? There's renewable energy, there's electric vehicles, green energy is that umbrella, but under that there's so much happening. Any new themes that you see which investors could look at from a long-term horizon?
I think, Sonia, if on a bottom-up basis, we can pick up stocks which have pricing power. We are all seeing inflation hitting raw material prices. We need to invest in companies which will be in a position to pass the price rise. I doubt if there are many companies which can pass the full price rise, but if there are companies which can pass partial price rise, that will be a great advantage to their margin and bottom line. So try to invest in companies which have ability to pass the price rise to the consumers.
All right, Nilesh, thank you very much. Great speaking with you. And hope that the performance continues. As Anuj said, skill is the name of the game, and you've got a very skillful team. The entire fund management top brass who we speak with and have the pleasure of interacting with. Thank you very much.